Unfortunately, you have been lied to. Yes, both in school and early in your career, you have been fed misinformation about PE ratios and price multiples in general. But lucky for you, I am here to correct and dispel the two biggest myths that you have learned. And by the end of this video, you will be ready to use price multiples correctly and to your advantage. So myth number one, PE ratios are inversely correlated with interest rates. Now, if your schooling was like mine, you spent way more time covering earnings than you did learning about PE ratios. But the one thing you did probably learn was that PE ratios were always negatively correlated with interest rates. And that is because if you pick up almost any financial textbook, that is what it teaches, that this relationship always exists. But in reality, that is not the case. In fact, this relationship has changed a ton over time. From investment regime to investment regime, this negative relationship has not held up. Now, I'm going to show you a chart here that you might say, well, this actually validates academia's claim. High PEs have long been associated with low interest rates, and low PEs have long been associated with high interest rates. The first thing I want to point out, look at the R squared. Yes, it is positive. It is 0.36. That is relevant, but is not a very strong correlation. And this type of long-term analysis makes sense as to why students and investors and professors and textbook makers believe that interest rates and the level of PEs are always negatively correlated. But this is just not true. As I'll show you on this next slide, PEs experience different relationships across different investment regimes over time. So in the 1950s and the 1960s, you see that there was a positive correlation. Lower rates meant lower PEs. On the flip side, in the 1980s, they were negatively correlated. Lower rates meant higher PEs. And then in the 2000s, we saw that it flipped once again. Positively correlated, lower rates meant lower PEs. And so what does this mean? Yes, if you zoom all the way out, there is a slight negative relationship between rates and PEs. However, if you zoom in on specific periods, following that overall relationship that you've been taught will not be helpful. In fact, it may be harmful. And we can actually zoom out ourselves and see that this is changing a little bit. So this chart starts in the year 2000, and you can see through about 2012, there's a very, very strong positive relationship. There's a positive correlation between S&P 500 forward PE and the 10-year Treasury yield. Now, in the mid 2010s, about 2012, this relationship starts to break down. Now, it's still slightly positive, so I kept it here in blue, but you can clearly see it is not as strong as it used to be. And what that led to was a complete flip in this correlation in more recent years. So what does this tell you? Well, if you've stuck this entire time thinking that low interest rates meant high PEs, high interest rates meant low PEs, you would be stuck out to dry as these correlations have shifted over time. It is just not as big of an explanatory force as you are taught in academia. Myth number two, earnings are more important than PE ratios. Now again, as I mentioned earlier, most students spend way more time learning about earnings than they do market multiples. And this also shines through when you talk to investors. So this was a survey we did here on the left of our clients in 2017. And if we replicated this today, I'm sure it would be a very similar outcome. We asked what they thought the most critical input was to their investment process. And almost 70% of them said fundamentals, which in this case is a proxy for earnings. And only 20% said macro forces, which in this case was a proxy for PEs. Again, this is not surprising. If investors have been taught that earnings are more important, if you learn that in school, when you come into the field and you start practicing, you're going to follow those same principles. And we also saw a similar thing when it came to Bloomberg articles. So what are investors actually reading about? And 84% of those articles mentioned earnings, while only around 16% of them mentioned multiples. So you're taught in school that earnings are important. You're reading on Bloomberg that earnings are important. It is not surprising that investors think earnings are the most important thing. However, if you look at the S&P 500's return over time and you were to strip out the PE expansion, you would be very, very unimpressed. So we did this analysis starting in 2012. We basically held the S&P 500's PE ratio flat, that is the blue line, and said, how would the index have performed if we only took the change in earnings and assumed investors were willing to spend the same amount for those earnings? As you can see, the regular S&P 500 with both earnings and PE ratio or PE expansion during this period highly outperforms the EPS only index. So investors are leaving a whole half of the equation on the table by not spending more time analyzing and forecasting PE ratios. So if you think about it, these returns are based on a few things. One, a company's earnings now and expected in the future, and then how much investors are willing to pay, or the price multiple they're willing to pay for the earnings now and into the future. That second part is almost completely ignored. Now, if we look at a return breakdown of the S&P 500, we actually find that PE ratios and PE expansions tend to be really, really, really strong. So rising earnings is not enough to carry the equity market. So we start here all the way on the left. We can see that PEs, when they move up and EPS or earnings move down, we actually have traditionally a positive return of 12.4%. If we go in the middle, no surprise that this is the strongest returns typically come when both PEs are both expanding and EPS is growing. And then in the third one, we see that when PEs are down and earnings are up, I actually reversed the text here. It should say rising earnings can be offset by falling PEs. So in that chart, reverse that in your mind. We can see that even earnings, when those are up, if PE ratios are contracting, you generally see a flat to slightly negative return. And this is what we looked at from 1985 to 2018. So this is a really long period of time. And then all the way on the right here, you can see when they're both down, not super surprising, that's when you see the worst returns, when earnings are contracting or falling and PE ratios are contracting. The two important ones to look at here are the column all the way on the left. So when earnings are down, but PEs are still expanding, you generally see positive market returns. And the third one, when earnings are up, but PEs are contracting, you see flat to negative market returns. So when there's these mismatches, PE ratios or market multiples tend to be really, really powerful. It can offset falls in earnings, or it can weigh on rising earnings. So if you can't use interest rates to forecast the S&P 500's PE, what can you use? Well, I didn't exactly say that you couldn't use interest rates. The point I want to get across with this is that PEs or market multiples are a very macro thing. So you need to be looking across the business cycle. Look at PMIs or proxies of risk like BAA credit spreads. You can look at inflation trends. I'll show you a chart to sum up this video on the next page that looks at inflation with PE ratios. So CPI, oil prices, China, yes, interest rates. Interest rates still play a role. It's just not as steadfast as you probably learned in school. And then overall risks. So what are their geopolitical risks? If the future seems more risky than the present across the globe, generally investors are willing to spend less for those future earnings. Trade wars or uncharted events like COVID-19. All of these things can play a huge role with PE ratios. And it's important that you're constantly monitoring the macro backdrop and how PE ratios are reacting to certain things. And here, I'll just show you another proxy, right? So I've shown you interest rates. Here, let's look at inflation. You can see the CPI here is inverted. So when inflation moves higher, you generally see forward PEs for the S&P 500 move lower. This makes a little bit of sense intuitively, right? Future earnings at that point would be worth less if inflation was higher. This didn't hold up during the tech bubble, though, right? So there are different periods of times across different macro regimes where price multiples can perform differently than you expect. However, We believe that investors should spend much more time on PE ratios than they currently do. In order to do that, you have to have a good sense of what the macro backdrop is. So I hope you learned something new in this video. I hope I was able to dispel the two biggest myths about PE ratios. If you did enjoy the video, I would highly encourage you to subscribe to the channel. Have a great week, and I will see you next week here back on Monday morning for another educational video.